Three companies report earnings over the next 2 weeks, and all three have options priced for a move bigger than anything they've actually done. Applied Materials is the clearest. Its options are pricing a 14.5% move. The last 5 times it reported, it moved about 6. That gap is the trade, but I want to show you the part most people get wrong first, because if you only look at one number, you will take the wrong side of this every time. Here is the calendar. AMD reports Tuesday the 4th, after the close. Cisco the following Wednesday. Applied Materials the day after that. And watch the deadlines rather than the report dates, because they're what actually binds AMD has to be on before Tuesday afternoon. That is the tight one. Cisco you have until the 11th, Applied Materials the 13th. This is every Applied Materials option on the board right now. Every strike, every expiry, and how expensive each one is. About 1,500 real prices. That wall climbing up the left side is the market charging a premium for downside protection, and the whole surface lifts as you get closer to the earnings date. Now here is the trap. That lift happens on every stock, every quarter, without exception. Implied volatility always rises into an earnings report and always falls afterwards. It is the most reliable pattern in options, and because it happens every single time, it tells you almost nothing on its own. High implied volatility is not an opportunity, it is the weather. The question is never, is this number big? The question is whether it is big compared to what this particular company actually does when it reports. So let's put those two things on the same picture. The yellow band is the move the options are pricing. Every blue dot is an actual earnings result, measured off the tape, Applied Materials. The band is 14.5% wide in each direction. The last 5 results, -8, -5, -14, -3, and up 1, average about 6. 4 of those 5 land comfortably inside a band built for more than twice that, Cisco. Priced for 9.9 typically moves 7, and AMD priced for 11.4 typically moves 8.8. All three are selling something wider than the history. That is the edge, and it is real. Now let me show you exactly what it costs when it is wrong. Applied Materials reports Thursday the 13th after the close, and this expires the next day, so you're holding it across one event and nothing else. The trade is an iron condor. Sell the 590 call, buy the 630 above it. Sell the 460 put, buy the 427.50 below. $13.15 of credit. That is $1,315 coming in against $2,685 at risk. Your break-evens sit at -12% and +19%. Now, the honest part of the 5 results I measured. 4 sit inside those break-evens. 1 doesn't. Last August, it fell 14%, and that would have gone straight through the lower one. So this is not a high probability trade dressed up as a certainty. It is a good price on a real risk. 1 bad print costs you 2 good ones. Cisco is the smallest position here, and the one with the most interesting recent history. Priced for 9.9%. Its average is about 7. Sell the 127 call, buy the 133. Sell the 108 put, buy the 103. $1.99 of credit, so $199 in against $401 at risk. Break-evens at -8.6 and +11.2, and here is what you need to see. Cisco used to be a 3 to 5% stock on earnings. Its last 2 reports moved -12.3 and +13.4. Both of those would have broken this trade. 2 of its last 6 results land outside the break-evens. That is a company whose behavior has changed, and the average alone hides it. Size this one small. AMD is the one on the clock. It reports Tuesday after the close, and this expires Friday. Priced for 11.4%, typically moves 8.8. Sell the 527.50 call, buy the 557.50. Sell the 435 put, buy the 412.50. $9.73 of credit, $972 in 2027 at risk. Break-evens -10.7 and +12.8. And the same warning as Cisco. 2 of AMD's last 6 results were outside that range. It fell 17% in February and rose 18.5% in May. This is a stock that does not do small numbers. The edge is that 11.4 is still more than 8.8. It is not that AMD is calm. 3 names I looked at and passed, and the passes matter as much as the trades. Eli Lilly. The options are pricing 7.5%. Measured, it moves 7.8. That is the market getting it right. And when the market has it right, there is nothing for me to sell. No trade. And SpaceX, which is the more interesting pass. Enormous implied volatility, a 16.8% expected move. But there are no confirmed earnings results in the data at all, because it has barely been public, so there is no history to compare the price against. I'm not going to sell a number I can't check. That is the whole method, and it has to apply when it is inconvenient. So 3 defined risk trades and 2 passes. Every one of them has a maximum loss, the day you put it on. And that is the only reason I'll hold anything through an earnings print. AMD has to be on before Tuesday's close. Cisco by the 11th, Applied Materials by the 13th. Every number here is off Friday's chain and it is linked below, so check it against the live market before you do anything. And remember what the red marks were. Roughly 1 in 3 of these companies' recent results would have broken the trade you just watched me describe. The edge is real, and so is the loss. Size them like the bad one is coming, because eventually it is. I'm Jaden. These are ideas, not advice. See you after the prints.